A possible shakeup for the mining industry. The Biden administration wants mining companies to pay royalties on the gold and copper they extract from federal land. It's part of recommended changes to a law that's been around for 151 years. We are back with Axel Merk to get his thoughts on this, as well as his outlook on the prospect of a gold-backed BRICS common currency following the summit in South Africa and the G20 meeting in India. All right, Axel, before we get into that, I want to start off where we left off in the first part of this interview, and that is with this JP Morgan report that says investor allocations to gold are at the highest since 2012. And an interesting fact in this report is that central banks buying is what's actually driving investors to buy more as well. The report says that there's little doubt that the pace of central bank purchases holds the key to gauging the future trajectory for gold prices, and that investors' allocation to gold looks rather high by historical standards at the moment, and that one needs to assume a structural increase in central bank demand beyond historical norms due to fear of sanctions or general diversification away from G7 government bonds to be bullish for gold. And in this report, investors are identified as non-bank investors globally. JP Morgan further breaks that down to private investors holding gold via coins, bars, or physical gold, as well as ETFs and similar products. All right, so if we're at an over-decade high in gold investor interest here, why are we not seeing that in the price? And what does that mean for future price action?
Well, first of all, I think the reason why the price of gold has held up despite higher rates is precisely because of the factors that you're driving. And so the question now is, will that persist, right? Does that mean we're at a high and will come back down? Or are we at a high and going to stay there or move higher? And your guess is as good as mine, but if you look at the driving forces, some people say that this economy will normalize. I don't see the normalization. By all means, the supply issues we've had from COVID, many of them are normalizing. But there's a war in Ukraine, if I can remind people. And I would like to, I don't like to, but I think we need to take it a step further. I think the peace we have seen since World War II has somewhat come to an end because we've seen that there are more factions in the world that have interest that they will not hesitate to press also to military actions. We have this big arms race everywhere in the world, and for the time being, of course, we are quote unquote happy that people are taking the defenses more seriously. But those dynamics can play out in any which direction over time. We also, yes, we're at a historic high or structural high in gold holdings. But if I can remind people that that deficits in a decent economy are dramatic right now. The Wall Street Journal, as we're speaking today, has an article that that the Biden administration has really no interest in tax hikes either. So it doesn't really matter from that point of view who will be the next president, that the vast majority of people are not going to experience a tax hike, pointing out that the upper 1%, so to speak, has, with some variation, had fairly steady taxation, but the middle class and the lower income people have had substantial rate cuts over the years. Well, unless they are accompanied by spending cuts, that means deficits are going to be through the roof, notably also through a recession, and notably if the Fed is quote-unquote higher for longer, which means the refinancing is more expensive. And so, yes, I would think it's a rational reaction that the interest in things like gold is increasing. Is that a guarantee that the interest will remain high? Of course not. And if you just take central banks, just on the other side of the pond here, that we have, if you're China and you've seen the hostile stance that both Republicans and Democrats have, you may want to put a little bit more money into gold and a little bit less money into treasuries. And these things are marginal changes. I'm not suggesting the Chinese are dumping the treasuries tomorrow because it's not in their interest. But on the margin, yes, foreign central banks have a greater interest to be not part of the SWIFT payment system. There isn't really a good alternative. And so gold is a component that is part of that. And so all of that means that there may be great allocation. Now, I'm one of the first to say, don't cry. This time is different, and people will forever have a higher gold allocation. And so there's a risk that yes, things will normalize. I just don't see that as my baseline scenario.
Okay, before we touch on the central banks, you did bring up the idea of geopolitical tensions. And it seems like the gold market and the markets at large are completely dismissive of this. I mean, as we're talking, Russia's President Vladimir Putin has been talking to North Korea's leader, Kim Jong-un. They're discussing military arms deals, and that's just kind of shrugged off by everyone, right? And as you quite rightly point out, there is still very much a war happening in Ukraine. Why do you think gold has not been that responsive to geopolitical tensions? Or do you think it has, and that's why it's weathered the rate hikes the way it has?
Yeah, I never like it when gold spikes because there's a terrorist attack somewhere or war breaks out. And the reason is that the markets get used to stuff. The market is used to terrorism. The market gets used to war. Initially it's a shock, but then actors find a way to continue to operate one way or the other. And so just as the Russians are figuring out how to trade or get imports, obviously more difficult and they don't get everything, but the price of gold tends to react early and then that reaction tends to fill out. And so unless there are more structural changes, like the US would pass some laws that would dramatically change the perception of the price of gold, I don't think it's going to have a long-term impact. And so in that sense, it's a sideshow. Now, what is not a sideshow is that if one just takes a big picture approach to both war and political tension, well, it means that procurement chains are less efficient. That means the cost of producing goes higher. And that has an impact on inflation, right? So on the margin, that's where I see it having an impact. And then, of course, you see governments don't like that, and they start intervening, and that further then disrupts channels because they tend to be not as good as the market in asset allocation and in allocation of resources. And so that tends to drive deficits, that tends to drive inflation higher. And so all of that suggests that the environment that will be going forward is going to be a tad more inflationary, if not stagflationary, compared to what we're used to. But those are changes at the margin, right? And so it's one of the reasons why I'm a long-term investor, because trying to trade the next war that breaks out somewhere is it's good for the guys that do it, but that's not my cup of tea.
Right. Well, let's focus on what you said about China and the central bank purchases by the People's Bank of China, because it's been really on somewhat of a shopping spree since November of last year, adding more gold to its reserves every month since then. In August, the People's Bank of China bought another 23 tons of gold. That means that China has bought 126 tons of gold so far this year, increased its official reserves to more than 2,100 tons. And that's according to what they're reporting. That's at least what we know, right? Analysts at BMO suggest that this number could be even higher. So what do you make of this? What do you think is behind China's very aggressive gold purchases?
Well, they need to recycle. They still export a lot more than they import, right? They need to recycle the money that they have, and gold is one of the places where to park their money. They don't have open borders, open exchange rates. They don't want their currency to strengthen. If anything, they want it to weaken, and so they'd rather buy gold. It's really as simple as that, right? The Chinese have many challenges. They think they can tackle them with a heavy hand. It's not easy, but for the time being, buying gold is one of the things. And of course, as long as they do that, they don't disrupt too many other things that they do domestically. What they would really need to do is some structural reform internally, but that's not really on the calendar. And so yes, it's just a symptom of the times we're in, right? That central banks are buying gold, and China, obviously being as big as they are, they make a difference.
So there was speculation that those record gold purchases by central banks were in fact leading up to the launch of a gold-backed or commodity-backed common BRICS currency. And there was some expectation that this would be discussed at the summit that took place in August in South Africa. That didn't happen. But what did happen was a very clear pledge to continue to move away from the dollar and to use local currencies for trade. And we also saw a significant expansion of the bloc. 6 more countries formally invited to join: Saudi Arabia, Iran, Ethiopia, Egypt, Argentina, and the United Arab Emirates. And they're expected to join the group starting in 2024. Now, the argument has been made that even though it's a bigger bloc representing a bigger percentage of GDP and arguably more powerful, that in fact, it's going to be harder to get any kind of consensus and agreement on issues, particularly a currency, and that their interests are now less aligned when it was the original 5 members. And US Treasury Secretary Janet Yellen is calling the BRICS 11 the assembly of highly diverging interests. Now, India and China, they've had long time territorial disputes, but it does seem as though tensions between the big members are perhaps increasing. There was the very conspicuous absence of China's President Xi from the G20 summit in India. So do you see the expansion of the BRICS making it less likely that they will develop and launch a commodity-backed common currency?
No, but only because the chance was always 0. And that will offend a lot of your viewers, but that idea that people will agree on a gold-backed currency to compete with the dollar was always a bad joke. And the reason why it's a bad joke is because it's completely unrealistic. The reason to have a gold-backed currency, you have to commit to have your house in order. And it's not in any country's interest to do that, and none of the countries have their house in order. So that's one precondition. The other one, you allude to that, is you need to have an agreement. But the Europeans can't even get along in the Eurozone and manage that properly. You need to have a common fiscal authority to do that. How are you going to have a common fiscal authority between Russia, India, Brazil? I mean, but these theories come up all the time, and I think they're rooted in this thinking that things are bad and we need to have a reset. Well, the one thing people need to remember, there's always a tomorrow, right? Look at Latin America. A lot of countries are a mess, but life continues from there, right? In 2004 already, I said we're moving more towards a Latin American type of society, and the wealth gap is increasing, but the world is still there, right? And so it's just the fabric of society changes. We have a more polarizing society. We have more disruptions. But before we have this quote-unquote great resets, a lot more has to happen. Just remember the can kicking in the Eurozone. Politicians are amazing at kicking the can down the road, right? And so that's not going to happen. Now, is there something of a threat to the U.S. with this BRICS expansion? Well, clearly they don't like the dependency on the U.S. Clearly they're working on a bunch of things. One of the things they would love to do is be less dependent on the SWIFT payment system. And so those things will happen. That's a gradual process. They will happen at the margin. But in order to have a real competition to the dollar, you need to develop financial markets in other places of the world. And we are way, way behind, and it's not really happening there because you don't have the security of the rule of law in most of these countries. And so on the margin, yes, there will be a threat to the dollar, but it's not going to happen because a few politicians meet somewhere and decide that starting tomorrow everything is going to be well, and all the evil in the world is rooted out.
Okay, so things need to get way, way worse before we see any kind of serious change or reset. And as you say, there was a 0 chance of the BRICS having a gold-backed currency before the expansion of the bloc, and there's still a 0 chance. So I want to get your thoughts on the chances of this mining law overhaul happening in the US. The Biden administration is proposing a dramatic overhaul of a 151-year-old law that governs mining for gold, copper, and other minerals on US-owned land. And they want to now force companies to pay royalties to the federal government on what they extract. Now, under the existing 1872 law, the US government does not collect royalties on minerals extracted from federal lands, but the new plan would impose a 4 to 8% net royalty on hard rock minerals extracted from all federal lands. And there are approximately 750 hard rock mines located on US government lands, mostly in the western US. And all of these would be impacted under this proposal. And by the way, the figure does not include the coal mines, which already pay royalties to the federal government. So yes, this proposal would need to be passed by Congress, and it's likely that Republicans would oppose this. But what do you make of this move, Axel? How concerned are you about this? Or what are your thoughts on this potential proposal?
Well, first of all, it's a proposal, right? I just told you the odds are zero for the BRICS coming up with a new currency. The odds are a little bit higher than zero, but not in the current administration. There's no majority in Congress for what's being proposed, but it shows the thinking in the current administration. The context here is, of course, right, we have all this green initiative and supposedly we're going to have more domestic mining and all that. And then they come up with new rules. Now, there are a few components to that, right? One, they say, oh, they're going to foster better practices. Well, one thing I think that people, at least outside of mining, should be reminded of is that sustainable mining has been around way before the current green wave. You cannot get a mine a permit unless you do a lot of things for the community, unless you have a mine plan to restore things and so forth. The monetary component by the high royalties, that's of course an eyesore for me. That's probably not the worst of it. What's bad about it is the added layer of red tape that are added on here. We mine way too little. We are way too dependent for mining on other countries, notably also hostile countries. And so we need to find ways to make it easier to mine resources, everything from strategic minerals to also precious metals. And unfortunately, this proposal shows that while lots of subsidies have been passed now, the government is not behind its own word in suggesting that indeed they want mining to take off and have more domestic resource production.
Okay, but just to play devil's advocate and push back here, because this may have political appeal if you frame it in the context that the US is an exception here and that it doesn't collect royalties from federal lands. Australia, Canada, and Chile, they collect royalties on minerals. At least a dozen Western states also collect royalties on hard rock mining. And the Biden administration's Interior Department is trying to pitch this in a way saying, oh, it's better for American taxpayers. They're saying a royalty would ensure that American taxpayers receive fair compensation for minerals and elements extracted from federal lands. The fee could also pay for programs to boost mining permits, clean up abandoned mine lands, and help states and tribal governments that provide infrastructure and services to mining-dependent communities. So I get that obviously we're in a very politically divisive landscape, but do you think that there could be bipartisan political will for this, especially when you frame it in the, it's for the taxpayers kind of context of like small guy versus big mining company?
Well, Republicans have come out and say they don't like it. And so I even though that would be additional revenue, I don't think there will be an agreement. So unless there's going to be a strong majorities by the Democrats, this is not going to pass. That said, in every country in the world, you allude to it that there are fees. When mining does well, all the stakeholders want to have more money. It's one of the risks of mining investments that when the profits are high, it's not just the government that wants more money, it's the workers that want more money, and everybody else around it as well, the suppliers and so forth. And so that's part of the risk of mining. I don't actually see any tax in mining as being in the US, if it were introduced, as the biggest hindrance. The bigger hindrance is red tape. You need clarity on rules. Now, of course, clarity on taxation is also important, and clarity of taxation, in my view, is more important than the level of taxation. Mm-hmm. You need to know what the rules are if you want to allocate resources. And now the kind of the cat is out of the bag. We know that if the Democrats in power, there's a risk of higher taxation, and that will affect resource allocation. That will affect whether I'm going to allocate money to a project. So if you want to encourage mining, notably for strategic minerals, this isn't very helpful, right? But again, it's the red tape that's really the biggest problem in the US.
Okay, so the idea of them actually passing through something that collects royalties is dead on arrival because of what you say is the political division, and there's not going to be political unity in getting it through. But just the fact that this idea is out there would cause some concern, because it would cause more uncertainty with regards to regulation and create more uncertainty when it comes to investing in miners. So do you see this impacting domestic mining operations and allocation to capital of domestic miners? Should this conversationally, just the narrative, gain more traction?
Yeah, but it won't, right? Because on the one hand, this proposal is going to be dead on arrival. On the other hand, the more important political talking point is the green energy transition. So talking up a tax on mining it might be coming up in a few speeches, but I don't see that being a dominant theme. Instead, I was talking earlier to my portfolio managers that are at the Beaver Creek mining conference, and it wasn't a topic of conversation at all, right? It is not something that concerns them right now.
Okay. All right. And we, of course, also have Kitco coverage at the Beaver Creek conference. We do have our colleagues over there as well. We'll see if they're bringing that up in conversations. Finally, as we wrap up here, you did say that miners do well in a recessionary environment. So just expand on that thought for us.
Well, as many are aware, mining companies, especially the junior mining companies, are in some ways a levered play on the price of gold. The junior players, should they be able to develop a project, there's a huge potential relative to the cost that goes into it. And one of the stumbling blocks in the current environment is that accessing to financing is difficult for all but the most promising projects. And so if you now go into an environment where the price of gold is perceived to be more favorable, then the leverage, so to speak, to an improved environment, and there is far greater in mining than just about any other sector out there. And notably, a quote-unquote bad economy is good for these junior miners, whereas it is not good for most other companies. Now, and even in 2008, right, where credit in general was seizing up, in the gold miners, because of the potential for precious metals to do well, credit was allocated to that segment. And so it is, in that sense, a diversification play. It's a very speculative diversification play. The more senior miners, they obviously are producing already. And so, yes, there's what happens usually when the money shifts, the money first goes to the majors and then it trickles down to the juniors. But the juniors, because they have the higher beta, for the reasons I just mentioned, they then tend to dramatically outperform. Again, this is a very speculative environment, and I'm not suggesting that everybody pile all their money into those.
Are there any juniors that you have your eye on?
Well, certainly, but I'm not at liberty to talk about them, and it wouldn't be appropriate, because most of these companies have very thin trading volume, and it's not good to mention specific names on the air to pile money into those. But what we do is public. People can come to our website and then see what we like and so forth. But I'm very reluctant to talk specific names.
All right. So for our viewers, give us the details of your website as we wrap up here, Axel.
Well, without mentioning our products, go to merkinvestments.com is our website, and from there you can see what we do in the gold and gold mining space.
All right. Well, thank you so much for sharing what you are willing and able to share with us today. Certainly got some very interesting nuggets. So thank you for that. Axel Merk, appreciate your insights. Thank you.
Yeah, my pleasure. All right. Thanks, then. Take care.
Thank you. And once again, thank you, as always, to you, our viewers, for watching. Remember to subscribe if you're watching us on YouTube. For me, Michelle Makori, and the rest of the team here at Kitco, we'll see you next time.